Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. I'm a member of the board of the Foundation, and on every Monday we meet here together to discuss current market cycles and how to analyze cycles with our application we provide to all of you as members of the community with Cycles app. So what weeks we had with the magazine, the discussion on the magazine, the special guests we had during the past weeks. So it's hard to keep pace on this quality. So today, this session will focus on standard question and answers around cycle analysis with the Foundation Cycles application. So please rush in all your questions to the live chat, because I know I owe you a lot of questions during the past sessions. We had not the time to answer all your questions during the magazine discussion and the discussion with Dewey. So therefore, today I will take the time to go through all your questions related to cycle analysis and our Foundation for the Study of Cycles. So therefore, today we do a basic review of current market cycles with the cycle analyzer, and I will walk you through the settings and the advanced configuration options we have with the cycle analyzer. All right, so that's the next 20 minutes or 30 minutes. Let's get in. And I see, thanks for already posting the questions about the skewing function, which might be a good place to start today. I saw you raised this question also in the other discussions, so now it's a good place to keep up on the skewing of cycles. So this will be the first topic I will talk about. So for the ones who join the first time, maybe for today, what we do is we use our Cycles application we provide at the Foundation, go to the chart and review some current market statistics. So in order to keep you updated and to get back to your question around the skewing function, let's pick, let's start with the main markets here. Let's go to the S&P 500, and let's discuss about cycle skew and how to apply the cycle skew. To get more background on the skewness of cycles, I would recommend please visit the session from the Cycles magazine discussion, because in the current issue of the Cycles magazine, there is an article about the skewness of cycles, which means they are not symmetric anymore, at least business cycles. They are kind of asymmetric right now. There's more about in the Cycles magazine and in the talk on that. And today is about how to apply this for our cycle analysis. So I just used here the S&P just to pick the cycle. And you know, the standard procedure is let's pick the most dominant cycle here, which stands up, which is a length of 163. So the main procedure is look for peaks in the cycle spectrum with a high Bartle score and a good strength value and very short. So the first one which shows up here is with a length of 163 days, which is also on the second top position here. And now you can activate this on the chart as one cycle. You see this low is aligned here to the main market low, and it suggests that the turnaround is around the corner. But this is a symmetric business cycle, yeah? So this is the standard plot of cycles. Mainly in every cycle analysis, you will find, regardless of which charting application or tool set you're looking for, this is the symmetric cycle. Symmetric means that the length between the top and the low, yeah, here in this case, the top and the low is the same length between the low and the top. Yeah, so this is a symmetric cycle. And in the article I've written about why it's important also that we deal with asymmetric business cycles. You can configure here that in the configuration tab. So if you move over here to the configuration icon, switch to the configuration and go to post. So this is an setting which is applied after the analysis has been done. So the analysis has been on pure data, so the cycle length is detected based on standard digital signal processing. And down here below, you can now apply cycle skew factor, which means that we will shift from a symmetric cycle to an asymmetric cycle. If you activate this function, a standard factor of 0.3 is applied. This is a kind of finding which works well in business markets. But what does it mean? A factor of 0.3.5. Now the cycle will be applied once we press update. Yeah, what I will do here next. So what you see now is, and if I zoom in a little bit, that this cycle is now skewed, which means that the length from top to low is not the same anymore as from low to top. Yeah, and we can even make it a little bit larger so that you see the skewness even better. So this is the left-hand side of this cycle, yeah, which is now shorter in regards of days than the right-hand side of this cycle. So the duration of the upswing is longer than the duration of the downswing. Yeah, and this repeats with every cycle. So if you have a close look, this is not as symmetric as a standard cycle. So this is the skewness, and you can adjust the skewness factor if you go to the configuration panel. If we make a high setting, let's 0.8, you can switch it between -1 to +1. So a very high setting would be 0.8, and now we update, and you see now the skewness. This is more like a Skew wave, but in general you see now that the length between the top and the low is very, very short, and the upswing has a very long duration here. Yeah, so this is where you can change the skewness of the cycle. This is a very extreme setting. I would not recommend to go with that. So a standard factor, if you don't know what to do, keep it with the standard setting, which will apply this skewness here. And this is exactly the skewness which is reported if you read a lot of scientific articles around the asymmetric cycle in financial, or at least in business and economics right now during the last 30 years. It has been researched that the downswings of these cycles are more sharp and happen faster in time, while the recovery phase, yeah, which is the right-hand side, the recovery phase takes longer until the top is in place. And if we do cycle forecasting in current markets, at least for long-term cycles, we need to bring this factor in our models. Yeah, this might not have been the case 50 years ago. Yeah, 50 years ago, this asymmetric behavior was not visible or not seen. It is a special factor which has come in through the last 30 years. And there's a lot of research on that. But we are here on cycle forecasting in markets, and therefore you need to apply the skew factor into your current market forecasting models. There are a lot of reasons for this skewness. I will not talk about the economic reasoning behind the skewness. You can find this if you Google and search this on the net. We are talking here about cycle analysis and bringing these findings into our cycle research. I think most cycle forecasting methods will fail, yeah, if they do not include the skewness. So I think we are first of its kind, at least to bring this into here. And your question, I will now look also at the question, the main longer term formula as well as the sub-cycles. Yeah, this is now important. So if you read about the reasoning in the economic world about this business cycle, this is not applied to short-term cycles. This is the economic behavior in our daily to weekly, monthly interacting with the financial markets. And one reason which you will find out is about the measurements taken by governance to also impact the financial markets with different ways on how to do this. So there are different players on our current financial and economic markets which try to influence the markets. And that's the reasoning why we don't see the symmetric behavior anymore. But this only applies to long-term cycles. So if you're dealing with intraday cycles or even cycles on a very short length base, do not apply a skew factor. Yeah. So as a rule of thumb, I would recommend use the skew factor only if you have cycles above 100 days. So if you see here on the right hand side and you deal with the cycle scanner, it will show you the cycles here on a daily time frame. I would not use the skewness factor if you add cycles on this mix here if they are shorter than 100 days. So which is kind of third of a year or a quarter of a year. So and be aware that every cycle you apply here to this composite plot will have the skewness also included. Yeah, so you need to know that once you activate the skewness, the skew will apply to each individual cycle you select here. So you could select the shorter cycle of 32 days, and the skewness is also here. But as meant, the skew factor is also to account for what was found in economic market models. And these economic market models do factor in more weekly, monthly behavior. So therefore don't apply it to shorter term cycles. So you could you could activate a composite based on different cycles here if you keep the length of the dominant cycles above or close to 100 or even higher. I think then that's okay, because this is exactly what happens to the research here. So this would be valid here. So and you see also what happens to the models here. So exactly that the tops and lows do more closely relate to current market behavior here. So if you just have a look at this example, which I'm showing here right now. So this is the cycle model with 3 cycles picked. Yeah, so one with a length of 300. So the 3 longest cycles here, which have been found by the cycle scanner, they are still valid because the Bartle score is high for all 3, and also the strength score is in the higher range. So you could pick these 3 cycles. You have now a kind of long-term projection with longer-term cycles. And if we deal with long-term cycles, it's okay to apply the cycle skew. Okay, so that's it on the cycle skew. Let me have a look at your list of questions here in regards to the skew factor, and then I will rush through your other skew. So I think for today, I think this is a good starting point how to work with the skew factor. I think you can imagine what happens if you put a minus in. It will exactly shift the other way around. Yeah, and so therefore now this shifts the cycle exactly in the other way. So now the, sorry for doing that. So now you see that the downswing is very long and the upswing is very short, but this has nothing to do with the research. So be careful. This is absolutely wrong. Yeah, from a mathematical perspective, for sure you can do this, but the cycle skew you will find in the research is, and that's the standard setting here, 0.35. Yeah, so this is current research. Okay, that's it for the skew factor. We have other topics to talk about. Spectrum and average spectrum cycle futures extraction. Average power spectrum. Okay. Let's talk about 2 other features here in the let's keep it in the post-processing, because maybe you've seen it, and I think some asked about the current cycle phase and average cycle phase, and this also has a little bit to do with Hurst's method of applying cycles. Normally, if you don't change anything, it uses the average cycle phase for the composite plot. So the composite plot is when we activate 1 or 3 or 5 cycles for our composite model, which is then progressed into the future. It uses the average cycle phase. And the phase is here important, because the phase is where the low or the high, depends on what you're looking at, is aligned on the timeline, so on the time of the chart. What happens here? Okay, so I just see that but I think that's okay. So where you align the low and the high on market. Sorry for that. I just need to put in my power cord here. Give me a second. It's just live. Okay. Yeah. So the composite plot. The average cycle means the full data set the cycle scanner is using to detect the cycle is then used also to set the phase of the cycle. So the phase of the low or the high, so it doesn't matter, it depends on what you use, where the low is aligned on the time scale. Yeah, and it's the average of the data set you used. The current cycle phase is using a different approach in the way that it uses the full in-sample range for cycle length detection, but the cycle phase, so talking about where to align the low on the time frame, there it does not use the full length of the data set, it just uses the current. So the data more related to the current point in time for alignment of the phase. So it will not change the length of the cycles. The length is detected using the full data set. So let's say a cycle length of 40 days. And then the average cycle phase means this 40-day cycle, it's averaged from the phase that it fits the best on the whole data set. The current cycle phase aligns the low to the current market behavior. And this is the mathematical terms, and please excuse if I use this math language, but it's the same what Hurst was or is doing when he is aligning the low to the past major low in the markets, because the cycle length was detected from the overall data set, but then aligning the last low of this cycle, he uses from a visual point of view the last low that occurred on the market. Yeah, so that's a visual method to shift the phase of a cycle. This here is the digital signal processing, where it just looks at the current past and then shifts the cycle based on the current data set and not the full data set. So this is what normally all cycle models will just use the average phase over the data set. The special topic here is you can align the current cycle phase. If you do it, it will shift a little bit, and it doesn't matter much if you only have, I think these are 3 years of data. You will see a difference if you use 10 or 20 years of data for your cycle analysis, because then you have a very long data set for cycle detection, and this might be important to find the average length of the cycle, but it will be useless if you use the average phase of the cycle then aligned to the past 20 years, because cycles will move around the phase. It will not be static. So therefore, it makes more sense if you have a very long data set, use the full data set for cycle lengths, and then switch in your configuration to the average cycle phase for the composite plot. Yeah, so try it for yourself. On shorter data sets, you won't see any difference because it won't make much difference anyhow. If you use longer term cycles, you will see the difference here. Okay, spectrum and average spectrum, feature extraction, average power. So where? Okay, so there's another possible configuration here, which is related to the amplitude spectrum. This would require a little bit more time to explain all the details here, but in general, the standard way is you use the standard amplitude spectrum for your spectrum chart. The average power spectrum is doing two things. The power is the amplitude squared, so it balances a little bit more the peaks in the spectrum. It makes the peaks more visible, but that's just the power instead of the amplitude. And the average then is that it takes different windows, from your data set, because there might be an error just using these exact two data points from start to end. So this is where you just use one spectrum. The average spectrum uses, I think, at least 5 spectrum analysis, while keeping the current, the end date of the ensemble data fixed, and then slightly changing the start point of your analysis. So the point in the history when the first data point is available. And this might slightly change the output of each individual spectrum, but then it averages afterwards all the spectrums. This is a little bit similar if you apply smoothing to the raw data series upfront. Yeah, you get smoother signals, but we don't want to apply smoothing upfront, because smoothing upfront introduces a lag in the data series. So we don't apply smoothing upfront. We just do the spectrum analysis not only on one data series, on, let's say, 10 different data series, by keeping the endpoint fixed and then changing a little bit the starting point. So it varies a little bit about the past data, and then just averaging all spectrums which have been then achieved. So it's a kind of smoothing the spectrum, yeah, which brings outliners out and then averages where we always see the same cycle regardless of the starting point. So that will increase the value that the cycle is real, and the possible way that there's just a one-time cycle popping up. With the averaging approach, it will be smoothed down, so that even if it's seen one time on one spectrum, it will bring down the overall amplitude. And the power factor is then amplitude squared, which will even more balance the peaks in the diagram. So you could compare them both. In most cases, there is not a big difference in both, or just a slight effect which will not impact the overall forecast at all. So if you want to fine-tune your approach, I mean, the average power spectrum is more advanced and more smooth in regards to the spectrum. So you could deal with that. But if you want to compare with standard cycle approaches you know about, or other tools use, the amplitude spectrum is what everybody knows about and what's the standard approach. And the difference will not be so high. So it's more for the scientific perspective on that. Okay, so that's about the power spectrum. So keep it standard. Keep it to the amplitude spectrum. The average power spectrum will not make a huge difference here. And we will do more research on that moving forward, so we can comment on that in the future. Okay, so the Bartels factor. How does the Bartels value factor in? I see the dominant cycle and other cycles with high strengths often have low Bartels score. Okay, so let's talk for a second about the Bartels score, and this is always showing up. So what is the Bartels score? The Bartels score is a second measurement if you can trust a cycle or if you can not trust a cycle. Digital signal processing will reveal the cycles which are in this data set. Yeah, and it's based on the digital signal processing. It could reveal a cycle which has been present in the data set, but for example, maybe with just 1 or 2 repetitions. Yeah, so and yes, the cycle was there from a digital signal processing, but the amplitude might have gone down. So the amplitude varies also within a cycle. And the Bartels score now, it measures how stable or how much repetitions of this same cycle are valid from a statistical significance in the overall data set. So the higher the Bartels value, let's assume the Bartels value is 100%. That means that the cycle was statistically significant in the data set from start to end. So all repetitions of the cycle could be statistically verified in this data set, not only from digital signal processing. So Bartels score, a very low Bartels score of 0 to 10, let's say this way, means that the cycle might only be been able to verify once for 1 or 2 repetitions in the overall length of the data set, which means if you deal with a very short cycle length in a very long data set, which a low Bartle score means that this cycle was been there mainly only once or twice in the overall data set. And this is then critical. What you don't know if this cycle was statistically relevant in the current behavior, or it was just statistically relevant in the start of this data set. So this would something to extend on. You just know that the cycle was not permanent there. Not all repetitions are statistically significant. So the higher the statistical significance, the more stable the cycle was in the overall data set. So that's the main usage. So this does not mean in general that a cycle with a low Bartle score might not be good for forecasting, but you don't know if the low Bartle score means that this cycle was there maybe once in the past, maybe 3 years ago, and during the last 2 years, this cycle could not be any significant correlation to the current market data. Then you should, or you would not use this kind of cycle in your forecast models. Even the digital signal processing tells you the cycle was there. While if you have cycles with high Bartle score, it anyhow tells you, okay, these cycle repetitions have been there in the overall data set. So if you want to rely on cycles which are there for a lot of repetitions in the past, you go with a high Bartle score. However, we all know that cycles don't stay static all over the time. Cycles disappear, cycles come back again. So even a low Bartle score can give you some interesting correlations, but you're just not sure if it's currently valid in the past data. So maybe it's a complicated explanation, but I want to give you the background on that. So the basic usage is use cycles with high Bartle score because they had a lot of repetitions in the data set you used. The lower the Bartle score, not so much repetitions took place even if the cycle has been detected. So the risk is higher that this cycle might not be valid anymore. Or you need other measures to validate if you think that this cycle is valid in the data set. So one data set could have a low Bartle score. You could then detect the same cycle length in another correlated data set. For example, I'm often talking about sentiment data set like the VIX index, which you could use here for the S&P 500. So if the same cycle length is detected in the VIX index with a low Bartle score, and the same cycle length is in the S&P main data with a low Bartle score, then you have another or a different verification that the cycle is there. So summary, if you have a low Bartle score, please check other verification methods if the cycle should be used or not. So using other data set with the same length is just once. If you don't find the cycle anywhere else, skip it. Don't use it for forecasting models. Okay, so that's it on the Bartle score. The market pulse, the snapshot charts. Yeah, this is the feature which will be bring back once we upgrade our cycle analysis tools. So this is maybe news which will come. We will improve the features. As you know, our membership will now change a little bit. So this allows us also to add features which we already have prepared. So the market pulse will come back. This is my first answer. What is short? Short. You're right. What is the short and long-term cycle? Donna, you asked this. Yeah. When I talk shorter or longer-term cycles, I mainly differentiate cycles because the standard spectrum, which is running here in the cycle analysis, is run from 0 or let's say 1 up to 400 data points or bars. So this is daily data. Yeah. So we are analyzing 1 to 400 days cycles in this data set. And I mainly cluster them in shorter term cycles with a length of 10 days to 100 days. So there might be valid cycles in these shorter length period. And then I cluster it into longer term cycles then with a length of above 100, so 100 to 400. And therefore, and you can use this, this is why I use the phrasing shorter term cycles and longer term cycles. I think everyone has a different clustering way of looking on cycles. There's always a mixture of shorter term cycles and longer term cycles, as the nominal Hurst model also introduced shorter and longer term cycles with average length in different clusters. So therefore, or maybe to explain how I use the cycle models in forecasting is mainly that I'm looking for 1 or 2 cycles in a shorter time frame, so one in a length between 20 to 80 days. And then I'm looking for dominant cycles in the period of 80 days to 150 days. And then the longest cycle is in the range of 150 to 400 days. So, and then I try to find a model of these 3 cycles. So I have a short-term, mid-term, and long-term cycle in my composite model here. So for example, you could narrow the range. So if you just want to look for a shorter term cycle, you could give it a range between 30 and 80 and update it, and this will just show you the dominant cycle in this range, which is more than giving it a range here. So if, for example, if you just want to look out for longer term cycles in the scanner, you can go in the configuration here, and then set the scanner setting to the minimum. Let's say we look for longer term cycles in my definition, but you can now use the range to narrow down the range for the Hurst nominal model. So there's one cluster of cycles between 50 and 80 days. Yeah, it's an average length of 62 cycle days, I think, in the Hurst nominal model. But the current cycle is somewhere in between this range. Yeah, so you can set the range. This is for me a longer term cycle in this data set. And you can say, I'm not interested in cycles with the Bartels value below 50. Update the data set. And now you see the list gets more and more narrow. So you don't need to concentrate on all cycles in this list. So these are the 2 cycles I picked anyhow from the list. If you remember how I did it anyhow with my eyes quickly spotting the chart, but you can do it exactly this way. So these are the 2 longer term cycles. And please excuse and thanks for asking if I take the words shorter and long term cycles. Okay, and then you can, so these are the long-term cycles, then you can look for shorter-term cycles and you can compare these models here. Okay? Good. Next questions. More symbols. I think the in your market pool section, I need to look up the exact numbers. But the reason we are more or less limiting is we need to be aware of data growth. So maybe if we talk about limits, I need to check the market pools for a second. So I owe you that answer getting back, and I need to look it up because I don't have it in mind right now. But we did another change on data sets and usage. For example, up to some days ago, you have not been able to upload data sets above 5,000 data points. But this was not a limitation to restrict you or to make other membership models. It was, Joe, we need to take care of the data growth overall because the data is keep safe in our environment. But we have now extended this limit. So now you can upload up to 20,000 data points per data set already now. So you don't need to wait for it because it was requested to have much more longer data set analyzed. So we increased from 5K to 20K for each individual data set, 1 point. And there was an issue around data before 1900. So you can now also upload and use data 1500, 1600. So this has also been resolved. And while we're talking about that, there's a new button here. And this has often been questioned or asked by you. So you can also switch between the logarithmic scale and the normal price scale. I mean, it will not show much difference here. But if you have data sets like a cryptocurrency where we have these extreme data set, and if you watch it this way, now if you switch it to logarithmic view, yeah, you see that the logarithmic view might reveal more details here. So this is now also possible. Okay. Yeah, slower beer, faster bulls. This is a skew factor. Yeah. So if you want to apply and you need to be aware of in which market you apply these data sets. So cryptocurrency might be the other way around right now. So the skew factor and the economic asymmetric cycle behavior was researched in our current financial economic system. There is no research done maybe on the cryptocurrency where the asymmetric behavior might flip around, but there's no research there. So yeah, so you find it easier to use the average cycle and the normal spectrum. Yeah, okay. Can the program allow me to change the skewness factor in different times? So it's fixed. So the skewness factor is fixed about the data set. So right now you cannot adjust in different timing periods to adjust the skewness. This would be a good idea, and I agree in regards to that the skewness or this asymmetric behavior is not relevant to all time periods, but not yet. So I need to take this, or we need to take this into account moving forwards. Yeah, wavelet. I mean, there are different methods in regards to cycle detection. And maybe this is a special session then. It's more an inside session on the algorithms, not the cycle analysis here on the weekly session. And we will also allow to switch between different algorithms. But the algorithm we use here right now is based on, I would say, 30 years of research on digital signal processing. And we tried almost every digital method out there. So we don't just pick one because we know them. You can trust us. We tried more or less every digital method, and the one here is a special derivative of the Fourier transformation, but it's not the standard one. But this, at least for the data sets we're dealing about, is giving the best results here. Okay, so Mark, talk about the 2017-2021 cycle, giving one projection a few months ago and then refreshing, and it shows a full month different when a peak should occur. Yeah, I think you relate to, I think up to November, we had a very stable composite projection or cycle detection, even about these lengths of 170. And then the projection has run out of sync with the market. And then the new cycles have shown up, which then switched the projection. The short-term explanation, or if we want to review these data on the main markets, and thanks Mark for bringing this up, and most of you will know Mark was here discussing these discussions here, and I think we could bring up this situation if we go back to November, so we can kind of simulate this reporting here. So the light blue data is not taken into account, and this reveals the cycle here with the lengths of 170 something. This is what we talked about last year very often. And this cycle has helped us very much around this time here, even to exactly pinpoint this top here. This cycle was seen here. And then at the midpoint of the cycle. So this is what mostly happens. So here it was a very valid projection. Yeah, if we see, then it picked the top here, and then more or less, at least it stopped the upward move at this point in time, and a sideways move started until this point here. And then, from this point here, you see it has gone out of sync more or less. No? So the cycle has projected a down move into end of 2021, and the markets continued to move up here into February. So that's the situation where we had looked at end of the last year. And one thing, it's kind of observation you often have, that these projections might get out of sync at cycle midpoint passings or crossings. So often it flips around. So you can flip around the cycles at these midpoints, but I will not talk about that. So that's a common observation, that at these midpoints the projection flips here at this end. But what happened then, and I think this is what you referred to, Mark, is that if we now continue into the future, I will get back to you here. So if we bring the last point more into the current past and update our projection here, so what you observe is that the cycle with a length of 170 something is not stable. So the length has become shorter, and the low shifted a little bit to into the past here. But I mean, I cannot explain what happened here, but at least that's what often can be seen in cycle analysis, that a static cycle projection will not always be kept static. So the length shifts across, so it morphs, and the phase shifts. And that's the reason why projections might get out of sync. Sometimes they are stable for a very long period of time. Sometimes they get unstable, after just a quick period of time. I think that's more or less that's the holy grail we're all looking for to detect when a cycle projection gets out of sync. But I see your comment, Mark, and isn't it always better to always use as much history as possible to find the highest Bartle and strength score? And then use short-term cycles to confirm. Yes, that's a valid approach. So and therefore I showed, okay, so to detect the cycle length, a valid cycle length, I agree, put in more data, or even a lot of more data than just 2 or 3 years. So this helps us reveal the cycles in a longer data set, which are available from the signal processing. And then to find the current lows and tops of these detected cycles in a longer data set, and this is what first also use the current low, but this is the visual approach, then if you use this longer data set for detection, then in the scanner, in the post-processing, switch to current cycle phase, which will exactly do, I think, what you aim for, Mark. So you use a very long data set. You can use 10 years of data, or maybe 15 years. If we're talking about daily cycles, I don't think it makes sense to use more than 10 to 15 years. If you go to weekly or monthly, then you could use more data, but maybe 10 to 15 years of daily data for cycle analysis. So the detection of cycle length will not be influenced by this setting here in the post-processing, but to detect the composite plot. So then aligning this cycle for your projection, it uses the current low and high in the market, so that the phase is more aligned to the current market behavior. The cycle detection took the overall 20 years of data set. So yes, that is a better approach, Mark. I just second what you're saying. It's just that we get more and more to complicated ways of use cycle analysis. So therefore we need to be careful here in our market report as we introduce basic concept. But I fully agree with you. Use a long-term data set for the cycle length with high Bartle score, a lot of repetitions in the overall data set. Then use the current data set for phase alignment, because you don't want to have the average over 20 years of data. Okay, so the planetary configurations and their impact on cycles. That's I mean, planetary cycles is a topic of its own. So therefore it's not easy to put it into a software. I mean, it's easy to put it into a software, but it's very complicated because you need to know what to do with it. And that's, I think, more complex is the knowledge behind the planetary cycles than simply switching them on and off in a software. So that's and you need a lot of experience in dealing with planetary cycles. So I agree that it would make sense to add them, and we are also in discussion in our board on how to deal with planetary cycles and the knowledge around that. But as this is a very special case of dealing with cycles, we don't want to overemphasize the planetary cycles. So, and there's often always a relation between detected cycles based on digital signal processing and then maybe a correlation to planetary movements or cyclic planetary movements. So my answer is that, Tyler, yes, we have that in mind. We just need to be careful how to put this knowledge out because it's getting more and more complex, and we don't want to, or we need to be careful with the basic version, not to overwhelm users because it's not so easy to click there. Data issues with the Yahoo wrapper. I mean, what we apply is a wrapper around Yahoo. So we try to grab the data from Yahoo, which is provided via API functions, which we could not rely on that fully, but it's still available. So as long as it's available, we can use it. And if there are issues, it could be related on the one hand side to the API Yahoo is offering or opening or closing or changing. And on the other hand, we also have some internal mechanisms to not get every data point. So there's caching involved and other methods. So if you observe issues with the Yahoo wrapper, please be so kind and drop us a note via email in our contact forum. So just go to thecycles.org, drop us an email. It will reach us and we can look up what the issue is. And I really encouraged you to send us the emails, but because this will help us to get better. So if you see these issues, please, Jason, drop us a note. Okay, Mike, with regards to daily data, since we are concerned only with timing, shouldn't weekend days and prices be extrapolated in the data like the current weekday holiday toggled feature allows? Yes. So you're right. And to be honest, so what you're talking about is to bring everyone in. So we just analyze what you upload or put in, and the only pre-processing function which is currently there, which allows if on the daily data set there are missing or there are gaps on the weekdays are serious, it will be filled. So holidays or stock market holidays, but it will still not populate weekend data to get a daily data sets. And I agree, often it is more valid because cycles don't stop on weekends, just because it's Saturday or Sunday. The cycle movement will continue on that, and therefore in a lot of cycle projections it makes sense to interpolate the weekend. And we have this function. It's just not activated, but you are absolutely right, Mike. We need to add another feature here in the post-processing, which allows us also to fill the weekend so that we have a calendar day data set interpolating the data on the weekends. This will come in very, very close time. Time is continuous. Absolutely agree, Mike, and there's no disagreement. We just need to bring in this function to interpolate the weekends, which is not complicated, so it's still there. Tyler, the API, it will show up. We have not agreed on concrete publishing date, but during the next week and month we will upgrade the features here. And there is an API technologies behind that. So what we use here is the visual front end, but the full cycle processing here takes place in an API-based cloud version, which could be used without visual validation. So the tables, machines could read that even better than we. So, and that's the purpose where we are heading at the foundation for the study of cycles. So maybe thinking about robotics and machine learning, I mean, our way of reading cycles on the chart is the way we have done it 50 or 100 years ago. In the future, these algorithms just use the data, the Bartle score, the strength score, the spectrum plot here down below, and they can read the data even much better to use, and they can even learn very faster than we can do. So that's the reason for the API. And yes, we will open up the API feature, so you can call it from your individual charting application. Think about the use case that you have your own charting application, which you run, and you don't want to upload every data here in the application. You just want right out of your application, just get the dominant cycle or the scanner and then continue in your own application. So think about the second half of this year. I would expect that you could use the API on your own. Miguel, each 2 cycles here catches a bottom, the intermediate not. Please help me. Miguel, please expand a little bit your question so then I can revisit it and maybe try to capture it a little better here. Yeah. Mark, the cycle flipping phase change you mentioned when you're playing these inversions were not random. Yeah, that's what I said. This is more or less the holy grail in cycles research. We are all looking for what's the algorithm, what's the logic behind when cycles shift or flip. No one has found an answer to that. And I can confirm it's often seen that it's not random, but we have, or no cycle researcher yet has found a root cause or an algorithm which could explain when cycles flip or shift their phase. So if you have found something or want to talk about that, happy also to involve you here as a guest to talk about the cycle inversion and cycle flipping. The harmonics. Yeah, by the way, cycle harmonics, we will also show up more on cycle harmonics continuing here, because if you detect one cycle and then use harmonics of this cycle, you can alter the composite. But again, this is an additional topic. You mean the 160, 180 not catching bottom? Okay, let's have the 160. I mean, that's live, so we can, the 160 to 180 not catching the bottom, this one, but the 300 something, so only putting on this one. You mean maybe this is the longer term cycle? So you have 2 cycles in play here, that's right, and they are not in sync in regards to their phase, for sure. Here 2 catches a bottom, the inner. So not really sure what you're trying. So you can plot this one here, right? So this is the 160 you're meaning here, and this is the one which come in alignment here in June next year. So then they are in alignment. So you need to plot them differently. Then it looks different, but you cannot activate both here. So maybe let's or please drop me a note on that, and I can repeat it maybe the next week with more detail. Yeah, so streaming APIs, we did use it already in another way of using it. So Tyler, what you're thinking about, everything will show up, and it's still working in our backend. We cannot just push everything out here. In regards of time, we are running for an hour, and but thanks for your question. It was really today a Q&A session explaining a little bit cycle analyze with our cycle analyzer. As you know, this is what you all are using, and this is what we provide as foundation to get you started. And often these questions show up on how to use it, how to align it. So I want to dedicate today's session especially to talk about your questions and how to configure the the cycle analyzer for your own needs. I would call it a live session for today, as we are running now for an hour. I think we can run for days just going over the Q&As of you. So thanks for rushing in the questions. Please keep doing so. This is a live session and I want to help you write on your analysis. I hope this clarified a little bit again for today. So therefore, I hope you will get back to us next week, Monday, same time, same place, same discussion on cycles. We always try to bring something new here. But today I would say have a nice week. So we have Monday, stay safe, and then we will see you again next week on Monday. Thank you all. Bye.